Prior to tax year 2020, partnerships were able to report the capital accounts of their partners using various different methods, including tax basis, GAAP, Section 704B, and other methods consistent with Form 1065 and its instructions for that year. Beginning in tax year 2020, with the filing period for 2021 and going forward, partnerships will be required to report the capital accounts of their partners using the transactional approach for the tax basis method. Under the tax basis method outlined in the 1065 instructions, partnerships need to report partner contributions, the partner's share of partnership net income or loss, withdrawals and distributions, and other increases or decreases using tax basis principles.
The CARES Act removes the limitation on excess business losses for non-corporate taxpayers that went into effect in 2018 as a result of the Tax Cut and Jobs Act. The limitation is now postponed until 2021 and will apply for taxable years beginning after December 31st, 2021 and before January 1st, 2026.
The CARES Act, enacted on March 27, 2020, made several changes to the tax law regarding net operating losses, or better known as NOLs, arising in tax years beginning after December 31, 2017 and ending before January 1, 2021. The Act now requires NOLs generated in 2018, 19, and 20 to be carried back 5 years unless an election to waive the carryback is filed. Before the CARES Act, NOLs generated in 2018 and beyond could only be carried forward and were also limited to 80% of taxable income. It's important to look at both your 2018 and 2019 returns to see if an amended return can be filed to claim refunds. The due date to file Form 1139 for 2019 NOL carrybacks is 12/31/20. Otherwise, an amended return will need to be filed and it may take significantly longer to obtain your refund. 2018 NOL carrybacks can be claimed by filing an amended return at this time.
The Tax Cut and Jobs Act, which went into effect in 2018, placed a $10,000 cap on the deduction of state and local taxes for personal income tax filers. After deducting real estate taxes, many taxpayers have found themselves unable to receive a tax benefit for the taxes they pay when filing their state personal income tax returns. In response to this, certain states, such as Connecticut and recently New Jersey, have enacted taxes on pass-through entities, such as partnerships and S-corps, on their partner and shareholder state-sourced income. The result of this is to allow the pass-through entity to expense the tax at the federal level, thereby benefiting the partner and shareholder to receive the benefit through a reduction of their allocable share of income. On November 9th of this year, the IRS issued Notice 2020-75, noting that it intends to issue proposed regulations that will clarify that specified income tax payments completed by a partnership or S-corp are deductible by the entity and are not accounted for when applying the state and local tax deduction cap to the partners and shareholders of these entities when filing their personal income tax returns. With the issuance of this guidance, more states may pass similar entity-level taxes to allow partners and shareholders of pass-through businesses to benefit.